All right, diving right in, today we're looking at investing.
Specifically, yeah, we're going to be looking at some excerpts from Zero to Millionaire,
Ooh,
a
okay.
guy by Nicolas Bérubé.
Okay, cool. So I know that this book is all about challenging some of those like common myths
Yeah.
that we have about investing, and I'm really interested to see what it has to say.
Well, right off the bat, he kind of throws you for a loop.
Oh.
It starts with this story about Sir Isaac Newton.
Wait, like the Isaac Newton?
Yeah. Gravity guy, the whole deal.
Wow.
And, well, the South Sea Company bubble.
Oh, I've heard of that. Wasn't that like, what, the 1700s?
Yeah,
Something?
early 1700s. And, he actually made a decent profit initially.
He did.
He did. But then got kind of caught up in the whole frenzy,
Was the phone? Yeah.
FOMO, and bought back in at like way higher prices.
Oh, no.
And then when the bubble burst, well,
Ouch. So even, the genius, right,
yeah,
can get swept up in it all.
it really highlights that emotional aspect of investing and trying to, time things.
Right, like that whole idea that you can predict what the market's going to do.
Yeah, and that's one of the big things the book pushes back on.
Which makes sense. If Isaac Newton couldn't figure it out, I don't know what hope is there for the rest of us.
Exactly. He even goes into, like tulip mania.
Oh, yeah, that was another crazy one.
These bubbles, and they're fascinating, but the point is,
It's risky business.
risky business. Trying to outsmart the market.
So less, crystal ball gazing and more
More of a plan, more strategy.
more of a solid plan.
Yeah.
So where do index funds and ETFs fit into this whole picture? I hear those terms thrown around all the time.
Yeah, so he talks about, how it's kind of like
Okay.
owning a piece of the entire Tour de France peloton.
What?
The peloton, like the whole pack of cyclists.
Got it.
Instead of betting on a single cyclist to win.
Okay, so instead of trying to pick the one winning stock,
Yeah.
you're spreading your bet across the entire field?
Exactly. And that's kind of the strength of it. It's, I don't want to say boring,
Yeah.
but it's more like reliable.
Right.
It tracks the whole market.
Which generally speaking goes up over time.
Historically, yeah, it trends upwards.
Yeah. I remember there's this example in the book. It's two families, they invest just $1 a day
Right.
for their kids. One starts at birth, the other starts at 20.
Huge difference by the time they're 65.
And it's crazy, the difference.
That's that compound interest.
Yeah, that was eye-opening for sure.
Time working for you.
So, okay, but what about the professionals?
Yeah.
Like the people who do this for a living? Surely they can beat the market.
Well, that's another thing the book kind of debunks.
Really?
Yeah, there's this thing called the SPV report.
SPVA report.
It basically shows that, most actively managed funds, the ones run by the pros,
Right.
they actually don't do better than the market over the long term.
No way. So all that expertise and algorithms and, whatever secret sauce they're using.
It doesn't necessarily translate into guaranteed outperformance.
So, that really does kind of level the playing field then, doesn't it?
Absolutely. It brings it back to fundamentals and strategy.
He even talks about, what was that guy's name? Monish Pabray,
Oh, yeah, Monish Pabray.
who's a really successful investor.
Super successful.
But even he had a major flop.
Yeah, Horsehead Holdings.
Oh, yeah, that was rough, wasn't it?
Point being, even the best can make mistakes.
So diversifying through index funds seems like, I don't know, a safer bet.
Well, less about picking individual stocks.
Right.
And more about managing your behavior as the investor.
Okay, I like that.
That's key. The book really emphasizes that.
Because it's so easy to let fear and greed and all those emotions take over, right?
Yeah, he even has this great analogy about
What is it?
Watching a party through a window.
Yeah.
You see all the fun.
The excitement.
Yeah, and you get that FOMO.
Oh, I know that feeling.
Then you jump in right when the party's ending.
Yeah, you end up paying the highest price for the least amount of fun.
Exactly, and the media doesn't help, right?
No, always hyping everything up.
Feeds that emotional roller coaster.
So maybe step one is turning off those news notifications.
There you go. Tune out the noise. Focus on your plan.
Long game.
Long game.
So, okay, trying to time the market or pick individual stocks, it's probably not the best strategy.
Right.
But this idea of embracing market crashes, that still feels a little, I don't know.
Counterintuitive.
Yeah.
It is. But he kind of reframes it as an opportunity.
Really?
Yeah.
Because most people, they see their portfolio drop and they panic.
And they sell, yeah.
Yeah.
But He kind of compares it to like a sale at your favorite store.
Okay.
Prices drop. You can buy more, right?
Yeah.
For less.
Yeah. No, I see that. But I think to really understand this, we need to
Zoom out a bit.
yeah, zoom out. Like, how does the stock market actually work?
So imagine it like a giant auction house.
Okay.
With millions of buyers and sellers, and they're all trading pieces of companies.
Like what? Like Apple or something?
Yeah, Apple, Google, even, your local coffee shop.
So the price of a stock, it's basically just determined by
Supply and demand.
Supply and demand, yeah, like anything else.
Exactly. And those prices, they're, going up and down all the time.
Right.
Based on like company earnings, economic news, global events,
So if, say, a company announces record profits.
Stock price goes up.
Yeah. And if there's news about a recession.
Could trigger a dip.
A dip, yeah. It all feels kind of, I don't know.
Interconnected,
yeah, almost.
It's like part psychology, part information, part speculation.
But over time, the book keeps saying, the market
tends to go up.
Yeah. I mean, it makes sense, right? Companies are always, coming up with new stuff.
Innovating you.
The economy, generally grows over time. People want new things.
Needs, desires, yeah.
So that growth potential, that's why
it's been so powerful historically for building wealth.
Yeah, even with all the ups and downs.
It's like owning a piece of human
progress.
Yeah, progress.
Yeah.
Ingenuity.
Okay, I like that. That's a much more inspiring way to look at it than just staring at numbers on a screen all day.
Right.
But of course, nothing's guaranteed, right?
No investment is risk-free.
Right. There's always risk.
And the key is, you got to understand, the relationship between risk and reward.
The higher the potential return.
The higher the risk.
Right. So those get-rich-quick schemes,
yeah,
they sound tempting.
Very risky.
Very, very risky. Whereas a more diversified long-term approach.
Right.
It might not happen overnight, but
it could be a smoother ride.
Yeah, less stressful.
Yeah, that's why the book really emphasizes knowing your own risk tolerance.
Risk tolerance, okay.
Yeah, how much can you handle?
Volatility, yeah.
Yeah, what are your goals? What's your time frame?
So someone investing for retirement,
yeah,
they have decades, right? More time to recover if things go down.
Yeah.
But someone who's, closer to retirement.
They're going to want to protect what they've built.
Exactly, yeah. Which brings us to...
Asset allocation.
Asset allocation, yeah. So stocks versus bonds.
Yeah, finding that balance.
Right, because stocks, those are considered
growth assets.
Growth assets, yeah. Higher potential return.
But also more volatile.
More volatility, yep. And then bonds.
More stable.
Stable, yeah. They provide a cushion when things get rough.
Right. He mentions that rule of thumb.
Oh, yeah.
Subtract your age from 110.
So that gives you the percentage of stocks you should have.
But it's just a starting point.
Yep.
30-year-old might aim for 80% stocks, 20% bonds.
But it's not
it's set in stone.
Set in stone, no. It's more about
finding what works for you.
Yeah, what you're comfortable with.
What lets you sleep at night.
Speaking of things that can impact your returns, he also talks about dividends.
Oh, yeah.
That whole dividends are free money thing.
He pushes back on that.
He does.
Yeah.
Dividends, they can be a good thing.
Yeah.
But there's a trade-off.
Oh.
Because a company that's paying dividends, they might be missing out on opportunities to
reinvest that money.
Yeah, back into the business.
So it's a balance between paying shareholders and potentially growing the company even more.
Exactly. And the stock price usually goes down
when a dividend's paid out.
Yeah, so it's not really free money.
Right,
yeah.
Right. I guess it's all about having realistic expectations, even in the world of investing. Yeah, there's no such thing as risk-free guaranteed returns.
And speaking of practical considerations, we can't forget about
taxes. They're part of it.
They always are.
But there are ways to be smart about it, especially for long-term investing. He talks about IRAs, Roth IRAs.
Oh, yeah, those tax-advantaged accounts.
They'll be your friends.
Yeah, they can really boost your returns over time.
Absolutely.
With a Roth IRA.
You're not paying taxes when you withdraw in retirement.
That's huge, especially if you think you'll be in a higher tax bracket later.
Right.
But even if you're not sure, which IRA is right for you.
Doesn't matter. Just start. Yeah, any contribution helps.
Okay, so we've talked about, finding the right asset allocation. We've talked about managing risk, about dividends, taxes, yeah. But with all these funds and stocks out there, how do you actually choose?
This is where that simplicity idea comes back.
Okay.
Remember those index funds and ETFs?
Yeah, the whole buy the whole Peloton thing.
Yeah, exactly. It's a simple way to diversify.
Without having to, like...
Pick individual stocks.
Yeah, because that's...
Nearly impossible to do consistently.
Maybe for the experts.
Yeah, so Raven report shows that...
Most actively managed fund.
Don't beat the market.
Wow. So instead of trying to be smarter than the market...
You just kind of...
Ride the wave.
Ride the wave, buy the whole haystack.
Makes sense, but how do you actually do that? Like, where do you begin?
That's a great question, and that leads perfectly into the last part of our deep dive.
Oh, okay.
We'll talk about the different ways you can actually invest.
Okay.
The pros and cons, and some resources to get you started.
Perfect. Let's do it. All right. So we've talked about why keeping things simple can be the best approach when it comes to investing. But how do we actually, put this into action?
Yeah.
Where do we actually go to invest?
So the book lays out, 3 main paths you can take.
Okay.
And they each offer a different level of, control, hands-on involvement, things like that.
Gotcha.
You can use a discount brokerage, you can go with a robo-advisor, or you can work with a financial professional.
Okay, let's break those down, starting with, the discount brokerages.
Discount brokerages.
So, what are the key things our listeners should know about those?
So discount brokerages, these are places like Fidelity, Vanguard, Schwab.
Okay, yep, I've heard of those.
And they basically give you this, low-cost way to buy and sell investments. Could be stocks, could be those index funds and ETFs we've been talking about.
So it's like having a digital marketplace for all these different investments.
Right at your fingertips.
Cool.
And one of the biggest advantages is the low fees.
Okay, yeah, that makes sense.
You're managing it yourself, so you're not paying someone else.
Right. You avoid those big advisory fees.
Exactly.
And of course there's always a trade-off, right?
There is. With great power comes great responsibility, I guess.
That's right. You're basically on your own.
You got to do your research.
Yeah.
Understand what you're investing in.
Right.
Have a plan.
And the book talks a lot about discipline, right?
Yeah, big time.
Not getting caught up in the emotional roller coaster.
Avoid those impulses, yeah.
Yeah, don't buy high and sell low just because you're, freaking out.
Right, exactly. So for people who, they want to be hands-on, they understand the basics.
Yeah.
Discount brokerages can be great.
And before you even start picking specific investments, make sure you're taking advantage of those tax-advantaged accounts, right?
Absolutely, yeah. IRAs, Roth IRAs, all that good stuff.
Max those out.
Yeah, for sure.
Okay, so that's discount brokerages. What about those robo-advisors?
Ah, yes, the robot.
Tell me more about how those work.
So robo-advisors, these are things like Betterment, Wealthfront.
Okay.
Even Vanguard has one now. They're digital advisor.
Okay.
And they basically use algorithms.
Okay.
To build you a portfolio.
So it's like having a digital financial advisor.
Yeah.
Without having to actually meet with someone.
Without the fancy suits in the offices.
Yeah. That's cool.
So basically, you answer some questions.
Okay.
About, your finances, your risk tolerance, your goals.
Right.
And the algorithm takes it from there.
So it builds a portfolio based on your answers.
Yeah, usually a portfolio of ETFs that match what you're looking for.
That sounds pretty convenient.
It is. It is. And because it's automated, the fees are generally lower.
Than if you were working with a traditional financial advisor.
So
you get some professional guidance, but it's still,
cost effective.
Cost effective, yeah.
It's a good balance.
Perfect for people who they want a little help, but they don't want to go full DIY.
Exactly.
Now, what about those who they really want that human touch?
Yeah.
They want someone they can talk to, get personalized advice from.
That's where financial advisors come in.
Okay, but the book, it kind of has a word of caution about those, doesn't it?
It does, yeah. Because not all financial advisors are created equal.
Right.
You got to find one who's a fiduciary.
A fiduciary?
It means they're legally obligated to, put your interests first.
Okay, yeah, that's important.
Big difference. You want someone who's working for you.
Not just for their commission.
Right, exactly.
Yeah.
The book talks about, understanding how they're compensated.
Oh, right. Yeah, are they fee-based, commission-based? How does that all work?
Transparency is key.
Yeah, and don't be afraid to, ask questions.
Oh, yeah, ask lots of questions.
What's their investment philosophy? What's their track record?
Yeah, how often will they communicate with you?
Yeah, you're trusting this person with your money.
Big decision.
Huge decision.
Building that relationship, that trust.
Yeah, that's key.
That's super important.
Okay, so we've got, discount brokerages,
Robo-advisor.
robo-advisors, and then financial advisors.
Yeah.
But regardless of like which path you choose,
Yep.
are there like any universal principles that apply to everyone?
The book really hits on, diversification,
Yeah.
patience, discipline.
Yeah, even when it feels tempting to like jump in and out.
Yeah, stay focused.
Long game.
Long game.
It's a marathon, not a sprint.
Exactly. And remember, everyone makes mistakes.
Even the pros.
Even the pros.
Key is to like learn from them and keep going.
Adapt, adjust, yeah.
So as we wrap up our deep dive into From Zero to Millionaire,
Yeah.
what's the one big takeaway you want our listeners to remember?
I think it's that building wealth, it doesn't have to be complicated.
Okay.
Keep a long-term perspective, diversify, avoid those emotional traps.
Simplicity, consistency.
Patience.
I like it. Thanks for joining us on this deep dive
My pleasure.
into the world of investing, and we'll see you next time.